Why prices keep rising, even when demand falls. Most people believe prices rise because demand is high. But today, prices keep rising even when demand falls. This isn't a mistake, it's how modern systems work. For decades, we were taught a simple rule. When demand goes down, prices should fall. And when demand rises, prices go up. That idea still makes sense on paper, but in the real world, something has changed. Because over the last few years, demand has dropped in many areas, yet prices continue to rise. To understand why, we need to look beyond supply and demand and examine how modern economies are actually structured. The classic supply and demand model assumes three things. First, businesses are flexible. Second, competition is strong. And third, prices respond quickly to consumer behavior. But modern economies no longer meet these conditions. Today, many costs are fixed, markets are concentrated, and prices are often disconnected from real demand. This changes everything. Let's start with fixed costs. Most businesses today operate with high overhead: rent, energy, logistics, software, wages, and, most importantly, debt. These costs do not fall when demand falls. When sales decline, companies face a choice: lower prices and risk collapse, or raise prices to protect cash flow. In many cases, raising prices becomes the only option. Especially for businesses carrying debt, lower revenue can mean default. So prices rise, not because demand is strong, but because survival requires it. The second reason prices rise is monetary. When economies slow down, governments and central banks intervene. They lower interest rates, they inject liquidity, they expand the money supply. This keeps systems functioning, but it also reduces the purchasing power of money. Even if demand falls, each unit of currency now buys less. Prices don't rise because goods are suddenly more valuable. They rise because money itself is worth less. From the consumer's perspective, it feels like prices are rising. From the system's perspective, money is quietly losing value. The third factor is competition, or the lack of it. In many industries today, a small number of firms control most of the market. When competition is limited, prices no longer need to follow demand closely. If all major players raise prices together, consumers have no alternative. This is especially true in housing, energy, food, and healthcare. Even when demand weakens, prices remain high because the market allows it. One of the biggest misconceptions is that prices will eventually fall back. In reality, prices are sticky. Once they rise, they rarely return to previous levels. Businesses adjust expectations, governments adjust budgets, wages lag behind, and the new price becomes the baseline. This is why inflation feels permanent, because structurally it often is. For individuals, this creates a sense of confusion. You spend less, you buy fewer things, yet your cost of living keeps increasing. It feels irrational, but it's not. The system is responding to pressures that have nothing to do with consumer demand. Prices rise to stabilize institutions, not to reflect purchasing behavior. Prices no longer rise simply because demand is high. They rise because modern systems are built to protect producers, lenders, and stability. Understanding this doesn't fix the problem, but it explains why traditional logic no longer applies, and why, in the modern economy, lower demand doesn't always mean lower prices.